Welcome to Smart Tech and Finance US, where we decode complex trading strategies. Today, we master the ultimate indicator. Moving Average Convergence Divergence is a versatile tool helping traders identify trends, momentum, and potential reversal points in any fight. Many beginners think it is just a simple line, but this powerful oscillator consists of 4 distinct and highly dynamic components. Understanding these 4 elements is absolutely crucial if you want to stop guessing and start making highly profitable, data-driven decisions. Let us dive deep into the first core component, the main MACD line, which forms the beating heart of this indicator. This primary line is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. By measuring the difference between a fast and a slow-moving average, it reacts quickly to recent price changes and momentum. When the fast average moves significantly above the slow average, the MACD line rises, indicating that bullish momentum is rapidly accelerating. Conversely, when the short-term average falls below the long-term one, the line drops, signaling increased bearish pressure and weakness. However, trading based solely on this single line can be incredibly risky due to constant market noise and sudden price fluctuations. That is exactly why we need the second critical component, known as the signal line, to smooth out these erratic movements. The signal line is simply a 9-period exponential moving average of the MACD line itself, creating a slower trailing indicator. This smoothing effect helps traders easily visualize the underlying trend direction without getting distracted by temporary spikes or minor price dips. When we plot both lines together on a chart, their interaction becomes the primary foundation for generating reliable buy and sell signals. Now, let us introduce the third visual element, the histogram, which elegantly represents the exact distance between those two moving. If the main line is above the signal line, the histogram bars are positive and vividly displayed in a bright green color. Conversely, when the main line crosses below the signal line, the histogram turns negative, usually depicted in a stark red color. The height of these bars visually indicates the strength of the current momentum, growing taller as the trend rapidly gains power. Shrinking bars suggest that the momentum is fading, often serving as an early warning that a potential trend reversal is approaching. Finally, we have the fourth component, the zero line, acting as the ultimate boundary between overall bullish and bearish market conditions. When both lines hover above this zero threshold, it clearly confirms that the asset is currently in a strong upward trend. Alternatively, if both lines drop below the zero line, it indicates that sellers have taken control, establishing a solid downward trend. Now that we understand the structure, let us explore the most popular and effective trading technique known as the crossover strategy. A bullish crossover occurs when the MACD line boldly crosses above the signal line, generating a classic and reliable buy signal. This specific action suggests that the short-term momentum is accelerating faster than the long-term momentum, driving prices. Traders often look for this bullish crossover to happen below the zero line to catch massive upward reversals at the bottom. On the flip side, a bearish crossover happens when the main line drops below the signal line, triggering a sell signal. This downward intersection warns investors that upward momentum is exhausted and a significant price correction might be looming on the horizon. Experienced traders utilize these dynamic crossovers to optimally time their market entries and effectively manage their ongoing portfolio. Another crucial technique involves monitoring the zero-line crossover, which serves to validate the broader, medium-term trend of the asset. When the indicator decisively crosses above zero, it provides strong confirmation that the prevailing market sentiment has shifted. Plunging below the zero mark, however, confirms a bearish phase, urging traders to exercise extreme caution or consider opening. But the absolute holy grail of this tool is the divergence technique, highly revered for predicting major market tops and bottoms. Divergence occurs when the price action on the chart completely disagrees with the momentum direction shown by the underlying MACD indicator. Imagine the price is pushing higher, creating a new peak, but the indicator fails to reach a corresponding new high level. This dangerous scenario is called bearish divergence, a massive red flag indicating that the current uptrend is losing its internal strength. Even though prices look perfectly fine on the surface, the underlying momentum is secretly dying, foreshadowing a sudden and brutal. Conversely, bullish divergence happens when the price crashes to a new low, but the indicator actually forms a higher low point. This hidden strength reveals that selling pressure is completely exhausted, and buyers are quietly accumulating before a match. Spotting these subtle divergences requires intense focus, but mastering this skill gives you an incredible edge over ordinary. Let us transition to practical application by analyzing a real-time Bitcoin chart to see how this powerful tool actually performs. First, ensure your settings are properly configured to the standard 12, 26, and 9, which work perfectly for cryptocurrency market. Looking at this daily Bitcoin chart, we can clearly observe a massive price consolidation phase filled with extreme volatility, and notice how the price action creates several fake breakouts designed specifically to trap emotional retail traders into buying. If we relied purely on price candles, we might easily fall victim to these deceptive market traps and lose significant capital. However, by glancing down at our indicator, we immediately notice a glaring bearish divergence unfolding right before our very own. Bitcoin pushes to a new all-time high, yet the momentum histogram prints a significantly lower peak, screaming caution to everyone. Shortly after this vital warning sign, a bearish crossover materializes, confirming that the bears have officially seized control of. The subsequent price crash validates the signal, proving exactly why combining divergence with crossovers is an incredibly potent. But beware, because no indicator is absolutely perfect, and blindly following every single crossover will eventually lead to painful. During choppy sideways markets, the lines will constantly cross back and forth, generating a frustrating series of false. And this dangerous phenomenon is widely known as indicator whipsaw, and it is the primary reason why many novice traders fail. To effectively filter out this chaotic noise, professional traders always combine this tool with other key metrics, like trading volume. You should also incorporate major support and resistance levels to provide essential geographical context to the momentum signals you are. A bullish crossover happening right at a massive historical support level carries significantly more weight than a random crossover in. Furthermore, checking multiple timeframes is a fantastic habit to ensure you are not trading against the dominant, larger-scale market trend. If the weekly chart looks incredibly bearish, taking a short-term bullish trade on the hourly chart becomes a risky gamble. Let us examine another beautiful example where patience and proper indicator alignment result in a highly profitable, low-risk trading opportunity. Here, the asset drops sharply into a well-established demand zone, while the momentum histogram simultaneously prints a massive. We patiently wait for the lines to cross upwards, providing the final confirmation needed to safely enter a long-position trade. This systematic, rules-based approach removes destructive emotions from your trading process, allowing you to execute your strategy with absolute. Remember, the true magic does not lie in the indicator itself, but in how skillfully you interpret its complex underlying messages. Practice spotting these intricate patterns on historical data before risking your hard-earned money in live, highly unpredictable financial. By doing so, you will gradually develop an intuitive feel for market momentum, recognizing subtle shifts before they become glaringly obvious. Many successful hedge fund managers still rely on these foundational concepts, proving that classic strategies never truly lose. As we wrap up this comprehensive technical analysis session, let us quickly summarize the most important key takeaways you must remember. First, always understand the four core components: the main line, the signal line, the visual histogram, and the critical zero boundary. Precise entry and exit timing, but remain highly vigilant against false signals during flat, sideways market conditions. Third, pay very close attention to divergences, as they are your most reliable early warning system for impending massive trend reversals. Fourth, never use this powerful tool in complete isolation. Always combine it with robust volume analysis and strong history. By rigorously following these fundamental principles, you will drastically improve your overall trading accuracy and consistently protect. Trading is a marathon, not a sprint, and mastering technical indicators requires continuous learning, immense dedication, and unwavering. We hope this deep dive into market momentum has provided you with actionable insights to elevate your personal financial trading journey. If you found this detailed tutorial incredibly valuable, please hit that like button and share it with your fellow aspiring traders. Thank you so much for watching Smart Tech and Finance US, and we will see you in the next educational video.